David, back in 2014, you described to Michael Milken that we were entering the golden age of credit, and I know he hasn't forgotten it. Where are we? It's 2017. Is it the golden age of credit? Have things changed? Because right after the crisis, gosh, there were so many opportunities. Now everything is so fully valued.
Yes, what I was referring to was the secular change, or perhaps the cyclical change of bank regulation that was allowing investors for the first time to have access to capital that they never had access to before. And I think,
and that's a booming business.
I think it's happening, absolutely. Private credit raises are still not huge, but the opportunity set is big.
You say they're not huge, but if you add up the number of firms and funds in private credit, it's sizable. Hundreds of billions of dollars raised for private credit. Is it getting too competitive, or is there still plenty to go around?
I don't think it's getting too competitive. I think every one of those firms has a different niche. You know, we've raised a few $100 million that I would call deliberately for private credit, and there's plenty for us to do. And so I'm just not worried. There's a multi-trillion-dollar market for credit assets. And so I'm not sure if it's been $100 billion or not, but $100 billion versus trillions, I'm not worried about that.
You're targeting unlevered returns well into the teens. If you're looking for high return trades, like the dip financing, for example, that you provided to Radio Shack a few years ago, where do you find it these days?
Where do we find the opportunity?
Those kinds of trades these days?
Well, what's interesting is, in some sense, you have to go to an area which scares somebody else, right? Because there's so much capital, and we know that high yields are very low. We know interest rates are very low. We know PEs on equities are very high. Every asset class, real estate values, cap rates are quite low. So you have to be willing and able to do something that somebody doesn't want to do. So in some sense, it is not providing a loan against a stabilized property in Toronto or in New York City where valuations are very high. It may be going to a hotel in St. Louis where capital is very scarce and the property is not yet stabilized. And that's how you get 10, 11, 12, 13% returns.
Now, the reason other people are fearful of those kinds of opportunities is because the fundamentals appear to be poor, or there's a lot of hair on them?
There's hair on them. The property is not yet stabilized. The asset is in some sense scary, or it's gone through a downturn, and the people have been burned.
So hotels in St. Louis, if you will, tier 2 cities, that kind of thing, tier 2 properties in tier 2 cities. Where else? What else looks attractive?
Home builders. So in the U.S., Toronto, housing is a bit of a different story here in Canada, but in the U.S., we need more homes. We need more homes, and so the home builders need capital. Some of the home builders' balance sheets are in great shape. Some of the private home builders, some of the public home builders can't get access to debt capital the way they could 10 years ago before 2008 hit. So private capital is stepping in, and we're going to do a fund to raise capital to do off-balance sheet transactions for home builders.
You've described yourself, David, as a bottom-up investor who informs himself with macro.
Yes.
What's your macro view right now? How is that informing your perspective on credit?
I think one of the things for people who do distressed credit, some of us feel we're due a distress cycle, right? It's been 8 years since the last distress cycle, but it may very well be that we're in mid-cycle and not late cycle. I mean, spreads and yields and prices look like we're late cycle, but if you actually look at where's the leverage in the system, what are the actual issues, are there imbalances building up, it's not clear that we're not mid-cycle. So I don't think we're there yet to call for a recession or a bankruptcy cycle coming in the next couple of years.
So if you're right, and I've heard others say this recently, we could see this cycle play out for 4, 5, maybe even 6 years longer.
Absolutely.
What does that mean? What will the credit market look like 5 years from now?
Well, I think it's hard to imagine yields and spreads getting lower from here. So for example, in one of our funds, we're starting to short certain high yield credit names again. Not because we're expecting bankruptcies in the next year or two, but because we're able to find bonds to short that are trading at 107 cents on the dollar that are really priced for perfection. Company has a little problem, they might go to 97. And so there's some new opportunities in the market that we just haven't seen over this bull market over the last 8 years.
Do you find yourself drawn to the distress that is, for certain, attractive to others in retail and in energy?
Well, you have to look at the areas of stress, and there's no doubt that over the last couple of years there's been huge stress in both of those sectors, and we certainly have components of our capital across our different funds that are in energy, for sure. Retail, not so much, but we're looking at different complexes, and I think there'll be things to do there. In some sense, there's retail embedded in some commercial mortgage-backed securities, and that's a big component of our funds. And so we're analyzing what's happening with the underlying retailers and offices and other things in that space.
There's a big thesis, I know you're well aware of it, that so much of this retail property can be repurposed for nursing homes and gigantic gyms and indoor entertainment complexes. Do you buy it?
To some degree. I mean, that repurposing will happen. The question is one of valuation. At what price will people be willing to lease and pay for those spaces for different use? But yeah, the property will likely get reused.
On balance, are those properties still overvalued?
There are many that are. There are some that are doing just fine.